am happy that we are all here to talk about carbon capture and the 45Q credit. So I'm Mark Rogers, Principal, Business Credits and Incentives. I'll be followed by Mel Schwartz, 37 years of experience specializing in legislative affairs, 6 years on the staff of the Joint Committee on Taxation, and has served as the chairman of the Tax Legislation Committee of the AICPA. A Juris Doctorate, CPA, and overall good guy to know on Capitol Hill. He'll be followed by Adam Sweet. Adam was a tax attorney at the Internal Revenue Service, did a stint at the National Tax Office of PwC, and is now a partner at iBailey, leading our pass-through entity consulting group, extensive knowledge in partnership tax, Juris Doctorate, Master in Tax from Georgetown University Law, and then closing this out, Jim Donovan, 20 years of consulting experience, leader of our research and development group, and leading iBailey's employee retention credit efforts, CPA and MBA, and quite possibly the only person on this webinar that has run a 400-meter race under 50 seconds. Okay. So here are our learning highlights. Be on the lookout for detail on these nuggets throughout the presentation. We'll go into much more detail than how they're laid out here. I'll go really quickly. Credit available if construction begins by 2032. So it got extended from 26. They reduced the minimum capture. It's at 12,500 tons per year. The rates all went up, all got enhanced. And note, the 45Q credit is available every year for 12 years. 3-year carryback allowed, it was 1. Here's a game changer. The credit can be monetized, made refundable as a prepayment of tax. Credit can be transferred to third parties in cash transactions. There is a 5-year life for carbon capture properties, so another depreciation deduction play there. And then Jen will talk a little bit about the third-party eco accounting process. Okay, carbon capture sequestration 101. So now it's disclaimer time. We are an accounting firm. We are not scientists or geologists, but this 101 will set the framework for the 45Q discussion. So you are looking at 15 wedges to avoid CO2 as a greenhouse gas. Starting with number 1, end user efficiency and conservation, power generation. And you see CCS falls in that 6, 7, 8 wedge. Then you have alternative energy sources and wrapping up with agriculture and forestry. So not all the pressure for decarbonization is on CCS, but it certainly plays a significant role. So decarbonization, what's the role CCS plays? Right now, well, let's say this, as of 2021 data, there are 27 CCS facilities operational globally. And we need to increase that 100 times to get to by 2050, to get to our Paris Agreement goals. And to reach that magic number of 2 degrees Celsius, CCS needs to increase capacity from 40 million tons per annum to 5,600 tons per annum by 2050. And what will that result in, or what will that look like? Well, a lot of money is going to be spent on infrastructure, $655 billion to $1.28 billion, potentially in capital investment is needed, which will drive 70 to 100 facilities a year and jobs that come with it. So the takeaway here is we've made good progress, but need to step up and accelerate a little bit. And the hope is that these new incentives, 45Q, will propel that. All right, like I said, we're not science geologists, but this really speaks to us. What is carbon capture sequestration? Well, it mitigates emissions of CO2 by capturing it at the point of combustion and subsequently storing it in geological formation. So step 1, it's captured and compressed. Step 2, it's transported in underground pipelines. Typically, pipelines are the safest way to do that. There are other means of transportation, but pipelines seem to be popular. And the CO2 is stored mile deep in rock layers. And perhaps scientists could put in the chat if carbon turns purple when it goes underground. All right. So this is some telling data from the Global CCS Institute. Looking at your screen left, the blue dots are in development. There's certainly a lot of blue dots. The red dots are in operation or under construction. So you're just looking at North America here and a lot of activity. You can see some of the facilities in plant early development, starting with Dave Johnson plant going down. And in advanced development, again, this is taken from 2021. You see the industries and the countries. The takeaway here, though, is in the upper right of your screen, number of facilities. We touched on that 27, 4 in construction. Look at how many are in advanced development. 58. So more than double in advanced development than there are in operational. So it appears we're at an inflection point as these projects are taking off. And here's some more data from the Global CCS Institute looking at different industries. We'll spend a few seconds here to let you find yours. But what you're looking at is a timeline from 1972 through 2030. And you might be surprised to see that this technology has been around since the 70s. The red dots, again, in operation, blue dots under development, anywhere from cement production, iron and steel, coal, hydrogen, ethanol, fertilizer, natural gas. I recently attended the ACE ethanol conference, and carbon was a very hot topic there. You see a very big blue dot for Summit Carbon Solutions. Okay. And this is some data also taken from the Global CCS Institute. This was from their 2020 report of what's driving, at least financially, these projects. Far right, you'll see 45Q is pretty much touching every one, or is in the decision-making process for every one of these projects. The EOR, that's enhanced oil recovery. The LCFS is the California Low Carbon Fuel Standard. And you'll note that this 45Q is driving this from 2020, well before what we got a couple of weeks ago in the Inflation Reduction Act that's enhancing a lot of these incentives. So very promising. Here's a very wordy slide. I'll get right to it. It's important to know the evolution of this credit because it's really making a 180 since 2008. It was established in 2008. There was a cap on it, 75 million tons of qualified carbon. I think the numbers were 99% of the credit was taken only by 10 taxpayers. And then in 2018, things changed dramatically. They made it more attractive. They got rid of the cap. So now all of a sudden, people can play ball. In 2020, it was extended to projects that began prior to 2026. So it gave companies more of a runway to get this started. And then in 21, we got regulations on how to look at the law that was in 2018. So you see there's some lag time there between 18 and 21 before we got our regulations on this. And now that we got the regulations, a year later, the Inflation Reduction Act comes into play, and we'll certainly dig into that. All right, first polling question for the CPE. Where are you on your carbon capture journey? This webcast? Stakeholders are vetting out. Decision has been made to move forward. Construction has started, operational. Now, say the last year, me, Jim, Adam, and Mel, from the dozens of conversations we've had, I suspect a lot of A's and B's. This is new and fresh and kind of launching off. So as we wait for those final results, I will be handing it off to Mr. Capitol Hill himself, Mel Schwartz, And now that the CCS, carbon capture sequestration framework, is set up, and you might even see CCUS, which is carbon capture utilization sequestration, Mel will be digging deep into the 45Q credit itself. Yeah. And no surprise, Amy, A's and B's right now, which is the world we live in. Okay, thank you.
All right, well, thank you, Mark. And thank you, everyone, for joining us here. I think Mark gives us an excellent background on where carbon capture has been, where it's going, who is involved, what it entails. Let's talk a little bit about the credit, because this is, after all, the current incentive. We have an additional $3 billion of tax benefits put on the table to encourage 45Q, to encourage carbon capture. And I think really, you get down to it, the purpose of our discussion here today is to see whether there is a role for you, for your business, in taking advantage of some of that $3 billion. Okay, $3 billion, monetary incentive, current rules, and this applies again through 2022. There is a credit. 2022, it's $34.81 a ton. If you're sequestering the carbon that you capture, $25.15 a ton if you essentially use it for some other purpose, primarily as a tertiary injectant. What the Inflation Reduction Act of 2022 does is it moves up those amounts for carbon that is captured after 2022. So we're talking about next year's stuff. If you're not in place yet, then that's probably what we're talking about. But we're going from essentially $35 a ton to $85 a ton in 2022. And that is if you sequester the carbon. If you do not sequester the carbon, you do something else with it, but still a qualified something else, we're talking about $60 per ton. Now, note the parenthetical in both of these points. The total amount of the credit is 5 times the base amount of the credit. What is the difference between the base and the total amount? Well, it is whether or not the construction and operation of the facility meets certain wage and apprenticeship rules. These are going to be extremely important going forward. However, those rules do not apply. We're going to cut, the IRS is going to be required to treat you as having met those requirements and consequently eligible for the higher amounts, the quintupled amounts, so long as you begin construction, you begin construction within 60 days, from now until 60 days after the IRS produces guidance on exactly how do they want us to, what do they mean by meeting wage and apprenticeship rules? How do they want us to report other kinds of requirements? So at least for the time being, let's work on the assumption that we're talking about the higher amounts. As we get farther along, we may need to be conscious of how that plays, but we will have at least 60 days to put those concepts into place when that comes in. Now, okay, 45Q credit, those were the amounts per ton. How long? Is this permanent? No. You get the 45Q credit for 12 years, 12 years beginning with the month that the equipment is placed in service. And the idea here was that this gives a certain amount of certainty for investors. You do get a stream where it pays out. This is the rule that has applied in the past. There was no change to this rule in the Inflation Reduction Act of 2022. So $85 a ton or $60 a ton for 12 years. Once that, I guess the assumption is you've pretty much been rewarded for having engaged, and maybe you've even fully recaptured. Maybe we even need to replace the equipment at that point in time. There are special rules for replacing and improving equipment. We're not going to get into them today, but they are there and they will be available if, for instance, things wear out. That's why we have depreciation after all. What do you have to do to get the money? Well, you got to capture carbon oxide or carbon dioxide. You got to do the capture at a qualified facility, the construction of which has begun before 2032. Keep in mind, let's not forget how Congress got this legislation through. It was part of a Budget Reconciliation Act, which means they didn't need, you never need more than 51 votes to pass something, but unless you're using budget reconciliation or have some other special arrangement, you need 60 votes to take the vote, and they didn't have 60 votes. So everything has to kind of go away after 10 years. And that's why you'll see this 2032 or the 2033 drop dead date for this provision, for a number of other provisions in the legislation. So construction's got to begin before 2032, and we've got to securely store, fix, or use for a commercial purpose that carbon oxide or carbon dioxide that has been captured. If we securely store it, we get the $85. We fix or use it for a commercial purpose, we get the $60. Definitions, love definitions. Qualified facilities, facility that stores or uses the carbon in accordance with the rules. Great. Key is, did we get it? Did construction begin in time? We don't have specific guidance on this, but every other place that it, particularly within the environmental issues, every other place where the IRS has passed on how to define this, they have used a rule that says, one, if physical construction begins and continues, you can't go away for a couple of years and then come back. Or if you've incurred 5% of the cost, and 5% of the cost can include the planning and design. You meet either one of those standards, you are considered to have begun construction. Begun construction is important to determine whether certain rules are going to apply. The credit itself is not based on when construction begins. The credit is for capturing and sequestering the carbon oxide itself. Just keep that in mind. Two different tests that we have to use. Most people are going to, I think, be looking at disposing permanently, encapsulating the carbon. The rules talk about a secure geological storage space. Other alternatives are if you permanently fix it into a non-emitting form. I'm not sure that that's actually a word, but we're going to use it anyway. Essentially, you turn it into a rock, and there are some. there is some technology out there that is working towards that. Also, there are some biochemical methods that are being looked at. I don't know that any of them are fully developed yet, but may also ultimately come into play. Typically, what you're going to see, though, is either it is securely stored or it's used for another commercial purpose. An injectant for enhanced oil and gas recovery, like Mark mentioned earlier. If you happen to be next door to a Coca-Cola plant, you may have a market for your CO2 over there. If you follow the if you follow the beer press, there is a CO2 shortage for the small beer producers. I guess that's conceivable that maybe we can work some barter trades on that one. A secure geological storage place. What we're normally looking at for here is, and you saw a little bit of that, I think, in Mark's presentation. Typically, we're looking at either deep saline formations, something with a hard rock cap on the top of it, burned out oil and gas reservoirs, perfect. Coal seams that may still have the coal, but are not practical to mine, may actually be better used and more profitably used as storage for in the carbon capture process. The now, oh, here, well, we mentioned these three. I think this is a little repetitive, so we'll just move on from that. If I can get the slides to go. One note, there is, you do have to have a certain amount of carbon captured in order to participate with the credit. For most regular industrial facilities, you need to have 12,500 metric tons of qualified carbon oxide for the taxable year. If you're talking about electricity generation, and we're going to see this, we will see a lot of this in the electric generating area. You need to have at least 18,750 tons, and you need a design capacity. There are standards that are going to apply to the carbon capture equipment that you apply. Essentially, you need to be able to pick up 75% of the baseline carbon that you expected to be emitted. Now, that's not necessarily 100% of the plate on your utility, but 75% of what you reasonably expect to be producing in the context of carbon. All is not peaches and cream. You get the credit, but the credit itself can be recaptured. Primarily if it's a situation where you went out, you claimed storage, and then the carbon oxide leaked. So in the standards, you have essentially a net loss. Recapture period extends either 3 years after the taxable year for which you claim the credit, or if monitoring requirements for whatever reason are dropped off, and there are monitoring requirements anytime we deal with sequester, going to be published. Some of them have been published. Additional ones we expect to be published by the IRS and probably by the EPA or DOE. We're not quite sure how exactly all that is going to file through. But the earlier, that is the period in which recapture could take place. Now, how do we recapture? You look at it's done on a net basis. So if, for instance, I put in 10,000 tons of carbon this year, and based on the studies, it appears that 2,000 of tons that I have previously claimed, I've got leakage. The leakage is first assigned against what I put in this year. So instead of claiming a credit for 10,000 tons, I'm going to be able to create a credit for 8,000 tons. So long as I'm putting more carbon in, unless I have really pretty much a complete failure of the sequestration, then we're going to be looking at a reduction in the amount of credit. However, once I'm no longer, or once I get past my 12-year period, those next 3 years, any loss, because I'm not going to get any credits coming in, any loss is now going to be effectively a recapture. It's a dollar for dollar recapture. As the sign says, we test it against prior periods on a LIFO basis. Okay, so we've sequestered, we put the equipment in place, we sequestered. Who gets the credit? Who's got the claim to this credit? The final regulations that Mark referred to were produced under the original, not the original, but the older 48Q, but are clearly effective. There's no reason that they would be expected to change. It's the taxpayer who owns the equipment. And in addition, physically or contractually ensures that the capture and disposal, ensures that it will go the right place. You don't need to be the one who owns it doesn't need to be the one who owns the facility. It's the one who owns the equipment that starts out. But that's not the last place that it ends up, because there are abilities here to move the credit back and forth from where it starts here originally and to other players in the whole capture process at that particular facility. But as I said, whoever's going to start with it does need to make sure that assurances are in place, that it's going to be captured, it's going to be sequestered. You need a binding written contract. It needs to be enforceable. And there is, at least if you're going to have defined damages, it at least has to be 5% of the total contract price. It's got to be commercially reasonable. There's got to be all of the normal good things that you would expect to be required in an enforceable contract, one that, frankly, the IRS, the EPA, the DOE can rely on, even though they are not immediate parties to the contract. So that is, again, one of the items that would need to always be tested. Is this just a federal situation? At this point, the income tax credit is primarily a federal credit. The LCFS credit or the LCFS program that exists in California, where you're trying to guarantee an overall reduced credit effect of a particular project. You will also see 48Q qualified investment being turned around and possibly put into that LCFS market for payments by someone in California that is seeking to accomplish something and needs to reduce the carbon footprint of whatever they are trying to accomplish. And so they purchase your credit, your reduction, and apply it against their project. It's, trade, no cap, but trade. And there's no reason that this cannot be taken into account, as well as the income tax expense, the income tax recovery. There are also some specific provisions, property tax provisions, some other provisions in a few additional states. Texas, I think, has an excellent piece, but is primarily focused on the oil recovery, which of course then accelerates the taxes that Texas is able to assess on oil production in that state. Where does carbon capture make economic sense? Well, it's $3 billion here. We hope it makes sense in a lot of places. Some things to look at in thinking about whether your business is a good candidate for carbon capture. How big is your carbon stream? You do have to meet that minimum amount. And the bigger the carbon stream, the greater the economies of scale. It's not the only issue, but it is an issue. How clean is your carbon stream? If you've got a lot of NOx and SOx in your stream, then that creates additional burdens with regard to cleaning the stream before it is shipped off. And a lot of that relates not just to the question of we don't get any credit for sequestering NOx and SOx, but we do need to get the bulk of that out of the stream because of the corrosive effects it's going to have on, particularly if we're using a pipeline to transport from the situs of the carbon dioxide capture to wherever we're going to be sequestering it. If you're not going to sequester it, is there a commercial market available? Can you sell it to the brewery? Can you sell it to Coca-Cola? Can you use it in the it's used in the production of a number of chemicals. Do you have a facility, or perhaps are you interested in getting into a facility that gives you an immediate commercial market? Now, it's not as big a credit, but it's still a very nice credit. And it may well be that if you've got if you can do this locally, then we avoid some of the issues of having to ship it a long distance, which is transportation costs can be more of the cost than the actual sequester cost, than the actual capture cost, because we're laying a pipeline, potentially laying a pipeline. Yes, it's green. It's going to be green energy. It's going to be wonderful for the environment, but it is still infrastructure. And I think we're already beginning to see situations where there is opposition to somebody dropping a pipeline running across their pasture. One thing I noted, we noted about, well, how big is your carbon stream? We are beginning to see situations where smaller carbon streams, and where we're seeing this particularly is in the area of ethanol production, where effectively it's a multi-taxpayer gathering system. So the carbon dioxide is being gathered from a number of sites that are in reasonable geographic proximity and then shipped through. All of these are things that I would take a look at and as to how practical this may be, as to whether this is something which is potentially viable for your particular situation. Now, it is not just generating the credit that is going to be important. It's going to be figuring out how you get it into the hands of someone who can use the credit. And for that discussion, I'm going to turn things over to Adam.
So yeah, great. So thanks, Mel, for that intro. And again, thanks everyone for attending today. So, this may be less of the details specific to 45Q and carbon and all that. And maybe more on the point is credit monetization. And it's a word we use not just in the 45Q space, but really more generally in the tax incentive space, that Congress provides a variety of tax benefits to encourage behavior, right? We have energy credits, we have accelerated depreciation, we have all these different types of tax incentives. And then the question is always, so it's put out there to incentivize a certain behavior. And then if potentially you can take advantage of that, how do you monetize that benefit? So that's why we use the term credit monetization. So in specific to 45Q today, I think we'll walk through maybe a few ways that people have already monetized the credit, and maybe going forward with the new legislative changes, how people may monetize it on a go-forward basis. So just real basic, what are some different ways that you could generate revenue, from the credit? Well, I think from the two maybe, well, probably the most simple way would be to have someone else do everything, right? You sell your carbon stream to a third party and they install the equipment, they handle transportation, they sequester the carbon. Really on your side of things, it's minimizing the risk because you're not having to do all of that stuff. You don't really need any particular expertise because the buyer is going to be taking care of that. Mel was talking about the transportation costs or the sequestration costs. All of that would be the third party. And really, if you have a smaller carbon stream, or if you're a smaller operator, that may be the most efficient way to do it, is just to sell the whole thing on to someone else who can make use of it. The joint venture arrangement, I have another slide on this in a second, but this is a very common technique, not just for 45Q, but for tax credits generally, of how to monetize the credit, is you use a joint venture arrangement, a partnership. You can share risk. You can incentivize investors who maybe come in for the credit. And if you're the operator, for instance, if you're the owner of the land, or potentially the carbon, you can bring someone else in to operate it, to capture the carbon, and really even outside money comes in to fund the project and monetizes the credit. And maybe last, and we don't see this all that often, but in the credit space, but you could always do it yourself, right? You could capture the equipment, you could transport it, you could capture it, claim the credit. There's a certain amount of risk there. I'd say there's also a certain amount of cost involved. And I think you would need enough, that last bullet point is probably the most important one, but you'd need a certain size to really make that economically viable. Specific to the joint venture point, there's a planning technique that's been out for a long time, not specific just to 45Q, really most credits in general, and it's called a flip partnership. And the idea of a flip partnership is you bring in investors into a deal, and in this case on my slide, this will be on the left side. The investors bring a bunch of cash, and they take 99% of the ownership of a project. Sponsor comes in and owns 1%. And we'll keep it specific to 45Q here. So this joint venture would be the project company. It would own the carbon capture equipment. It would also be claiming the credit. The tax equity investor really is coming in for the credit. These are oftentimes banks will put together groups of investors that come in and invest in solar projects or invest in historic rehab projects, or in this case, 45Q, and they're specifically to get the credit. Now, along with the credit, because they're a partner in a partnership, the tax equity investor also gets 99% of the economics. Why 99%? Because IRS guidance generally requires the credit to follow how other items are allocated. You can't just allocate the credit on its own and then allocate all other income and loss items to someone else. That the credit follows the income allocation, the loss allocation, and so forth. So tax equity investor comes in for 99%. They get, generally speaking, they're going to get 99% of the credit, and then 1% is going to be going out to the sponsor on the other side of it. You need two owners to make it a partnership for tax purposes. That's why the tax equity investor only owns 99%. This provides the sponsor and the project company, what do they get? They get cash from the tax equity investor. So that's the monetization of the credit. Tax equity investors are putting cash in and getting a credit back, and that cash provides the liquidity for the project. I would just note we're simplifying here, for purposes of our hour with you, but there's a revenue procedure on point from the IRS. It's Revenue Procedure 2020-12 that gives very specific requirements for if you are a tax equity investor, how large your percentage has to be, when do you need to put in your cash, and so forth. So I'd reference you back to that if you have questions on that. We use the term flip because it's at a point in time, the partnership economics flip. So pre-flip, it's 99% tax equity investor, 1% sponsor. Post-flip, sponsor owns 95% and tax equity investor 5%. Usually that post or that flip date is after the recapture period for the credit, like in the investment tax credit space, which is often a 5-year, 6-year recapture. You flip after that point. The 45Q may be a longer horizon there, maybe 11 or 12 years, but after the credit has been fully allocated, and then after the chance or the risk of a recapture has ended, economics flip. Because remember that tax equity investors don't really want to own the project long term. They wanted the credit. They have to come in and get the economics to get the credit. Once they've been allocated the credit, they want out, and really the sponsor, who is the project owner, wants continuing ownership of the project. So, and there may be at some future point too that the sponsor has an option. I mean, there's some more rules here as well, but to basically buy out the tax equity investor for a certain price, so that the tax equity investor can just fully exit, and the sponsor, in fact, owns the project. So this is a very common, really for the last probably 20, 30 years, a very common structure. And there's nuances, and you can add extra partnerships, and there's nuances here that we're not going into, but a very common structure for how to monetize a tax credit. Tax equity investor cash monetizes the credit. You allocate the credit out to the tax equity investor. After the recapture period, you flip the economics, and sponsor potentially, winds up the project to be 100% owner. So how did the IRA, the legislation passed in the last month, change this? Well, it really opened the door for how to provides alternatives for how to really monetize that credit. Because generally, before the IRA, federal tax credits could not be sold, were not transferable. So if you think back to my previous slide, you might say in substance, you're kind of selling the credit, meaning the investor's cash goes in and they get the credit back. For tax purposes, though, we don't report it as a sale. We say the tax equity investor is an owner of the project, and they get their allocable share of the economics along with the credit. But now, potentially, you don't have to do that. If you really want to straight up sell a credit, now you can do it. It's not all credits. I think there's a specific list of certain energy credits that you can do this with. But importantly for us, that includes the 45Q treatment. I'd also say that this now more closely matches state treatment. I know states, on the state side, they often have matching credits. States have, not all of them, but many states have allowed transferable credits for a long time, meaning that credits can just be freely bought and sold. You don't have to become a partner with a sponsor. So you may be thinking in the back of your mind, Bailey's saying that it's not transferable. I thought it was always transferable. Probably what you're thinking is you have experience with a specific state. Like I think in Oklahoma, for instance, you've been able to transfer a credit. So how does this change things or change the monetization options? Well, potentially you wouldn't even need to do that joint venture, that flip partnership, the pre and post flip. Potentially you wouldn't even need to do that now. If you wanted to monetize the credit and you own a qualified project, you could potentially sell all or a portion of the credit to a third party. And then that third party would be able to use the credit for their own purposes. And you, as the owner of the project, would get cash flow to further your project. And you would sell it over the 12-year credit period. But perhaps a more simple option rather than having to create a joint venture with a complicated agreement and complicated tax returns. Generally, if you sell this to an unrelated party, there's no gain on the sale. Good. But on the other side of it, no deduction for the buyer, which, good or bad, it's hard to say, but no income tax effect either way. I'd also say we're waiting for a lot of details out there on this. It's a seismic shift in the federal space, being able to transfer a credit, but there are statutory limits to how much you can sell the credit for. So I put that out there too, to pay attention to that. And then lastly, if you didn't want to sell the credit, there's also what's called a direct pay option. Basically, it's a refundable credit. So meaning you could fully claim the credit if you're the project owner. You could potentially claim the credit and generate a refundable credit for yourself. I would just say there's a dichotomy of treatment between tax exempt entities, think states, cities, tribal governments, can fully claim this direct pay option. There are some limits for private businesses. It's not, private businesses can make use of this direct pay option, but there are some limits. So just pay attention, depending on what your profile is, may influence how much of this direct pay option you can take. So how would we compare this to that? We have our flip partnership on the left side and then the sale of credit on the right side. So we have a sponsor that's gonna own the carbon capture equipment. Sponsor wants to monetize the credit. What are some things they could be thinking about? Well, you could, again, do our traditional flip partnership that we outlined a couple slides ago. You can get the credit out to the investor. It's not a sale. It's just it's an allocation of the credit. The tax equity investor, along with the credit, gets a share of other items of the partnership. So if there's depreciation, for instance, that's a tax benefit that would go out to the tax equity investor. Sometimes when you're pricing, if you're the sponsor and you're pricing the tax equity investor's interest in the partnership, you're gonna increase the price by not only the credit, but also the benefit, let's say, of those tax attributes flowing out, depreciation and so forth. So that could be more attractive in the flip space. On the downside, flip partnerships are complicated. You need a complicated agreement. You have to file tax returns every year, probably for up to 12 years. You're going to have complex allocations where it's going to be 99%, 1% for a period of time. Then it's going to flip 5 to 95%. You're going to have to follow IRS regulations during all that time. So if you didn't like that, and if you just said, hey, that just seems too complicated, maybe the other option now that you can transfer this credit is you just straight up sell the credit. You don't need to have 12 years of 1065s and K1s. You don't need a complicated operating agreement. Sponsor does what they want to do with the carbon capture equipment. monetizes the credit by just selling the credit straight up to the tax equity investor. I think there's a certain amount of simplicity there that you don't see with the flip partnership. But I guess on the downside to it, you're not going to be able to price in, if you're attracting that tax equity cash, there are no other tax attributes going to the tax equity investor, no depreciation, no other amount of cash. All they're getting is the credit. So that could influence the economics as well. And with that, I will turn it over to Jim for the last 10 minutes of our presentation.
Awesome. Well, thank you, Adam. I appreciate that. So in the first 50 minutes, gosh, we've thrown a lot at you, right? In terms of law, documentation, how do you monetize it, how the law's changed. You know, the reality is Congress wouldn't be doing its job if they made it easy, right? Tax law is inherently hard. And we're here to help you. Right? At Eide Bailly, we have a phenomenal team willing to dive into the law and help our clients. And we strive to be the best in market where we have the right resources in place and it makes sense given our client base. Energy incentives is an area where we're market leaders, especially with 45L and 175D. And we're adding 45Q as it's going to overlap these other incentives. And we have experience building practices in this space. This is new law. And we're all on the same ride together, right? But we've developed a methodology to help you navigate 45Q and the other incentives around it. So we have a 3-step process Mark creatively calls ECO, exploration, creation, and operation. And it's really designed to help you on the journey. We know from the initial polling question, right? Many of you are just getting started in this process, and you probably have a lot of questions. So let's talk about why we need this process. If I can get there we go. Why do we need this process, right? First of all, you guys have all seen the news, right? There was an $80 billion funding boost to the IRS. They want to hire an army of agents, right? 87,000 over 10 years, right? Sure, it's over 10 years, but you're likely not going to have your carbon capture facility operational tomorrow. And the credit runs for 12 years. We have a 3-year statute of limitations. Gosh, there's a lot of things in place, and they're going to be hiring agents. You guys can see the quote from the Congressional Research Service. They're going to be looking at this incentive. They're going to be looking at monitoring. They're going to make sure that you report all the recapture. There's going to have to be some robust documentation in place in order to claim and sustain your 45Q credit, right? Which really gets to my second point. Are Excel spreadsheets going to cut it? Maybe, maybe not. I don't think the simple ones will. I think in this case, you're going to have a lot of robust documentation at every step to help satisfy the IRS that, hey, you deserve the credit and you're appropriately monitoring everything to maintain your credit, right? So our process is really designed to help you through each stage of the journey and really help with that documentation process as well. So let's talk about ECO, right? Or ECO, right? Exploration. It's really the first stage of this process. And this is where I think the majority of you are, right? It's understanding all the items around 45Q and how they impact you. For those that are in that investigative stage, you understand that there are a heck of a lot of options and it could be overwhelming, right? So we're here to help you get through that process. I will say we don't work in a vacuum, right? Mark mentioned it right at the get-go. We are not scientists. Our goal is to help you maximize your return on this investment, whatever that may look like. And working with your partners, your vendors is going to be part of that process. So in that initial exploration stage, we can help you review vendor contracts, talk about how the impact on your carbon intensity score, Adam talked about partnerships, right? And monetizing the credit. The scenario planning, I know is kind of a basic slide, but what's the optimal option for you? Do you want to maximize risk and get the credit, or do you want to minimize risk and outsource everything? You know, that those are some different scenarios that you may want to model out. Of course, there's the interpretation of the Inflation Reduction Act, and then the regulations that are going to surround 45Q. There are state credits to consider. And then, of course, part of this process, we could offer consultations with the IRS National Office on, hey, this is the position we want to take. Is this reasonable or not, right? So that's really the initial exploration stage. Then you get to step 2. Congratulations, you've decided to go down the carbon capture and sequestration path, right? How do we help you there? How do we help you maximize your return on this investment? Obviously, well, potentially 45Q is on the table, right? Which requires a lot of documentation, but perhaps you're outsourcing, maybe not. But there are other incentives that could be in play here, right? There's always depreciation to consider for the assets you own. Can we accelerate that? Are there R&D tax credits? Mel mentioned 48C, right? Other energy incentives that could overlap here. Combined heat and power. There's things like prevailing wage that we need to make sure that is being paid to maximize your credit. We could look at soft costs, such as environmental costs and how you're treating those. And then, of course, 179D. So a lot of other incentives to look at through this creation phase to make sure that you're getting the most bang for your buck, right? All right, step 3, finally, operation, right? Congratulations, now you are saving the world 1 metric ton at a time. Now what? You know, how do we make sure we're in compliance, right? It's a 12-year credit. You know, again, we want to make sure that we're managing that credit. You know, are we getting all the benefit? Can we utilize it? Gosh, you know, part of it's refundable, right? So, hey, that's great. That's cash in our pocket. But if we didn't go down that path, right, what about the other incentives? R&D, you know, there's a lot of things that, hey, now we have them in place. I want to make sure I continue to get them, right? But then there's other things. Gosh, do we need a carbon accounting software solution? You have investors, stakeholders, right? They want to understand you know, in your financial statements, they want to see that environmental, social governance disclosure. You know, that may help with additional investors. You know, obviously you have your tax form 8933, which is your 45Q credit. Other tax strategies and adaptations, elections, and then finally tax controversy, or IRS controversy, right? We certainly have a dedicated team of folks that help with that. Many ex-IRS attorneys, just because you never know when you're going to get questioned, and they help us through the process. So again, ECO is a 3-step process, and it's really designed to help you through your carbon capture and sequestration journey. All right, so you probably have a couple of questions, but one of the things we're going to do before I highlight that last question is do a polling question. And so, you know, you've sat here for the last 56 minutes now, right? You've heard the need. You've heard the incentive, right? My question is, where do you stand? Are you skeptical? Do you think, gosh, I don't think there's going to be a lot of new carbon capture projects. It's going to stay flat, right? I think Mark said, what, there's 12 in the US. Or are you a true believer? You know, option C, the number of CCUS projects is going to exponentially increase, or are you know, safely in the middle, right? Well, we'll see what happens. I think it'll increase. That's option B. So I'm curious as to the results on that. But, you know, we want to help you on your carbon capture and sequestration journey. And so we're here to help you. We're setting up discovery calls really through the end of the year. So please feel free to reach out to any one of us, and we can talk about, gosh, where are you in your process? What help do you need? Who are you partnering with? Again, a lot of questions out there regarding carbon capture. And, you know, there's a lot of wonderful vendors out there that can show you part of it, right? But there's the accounting side too that you can't just neglect. And so that's where we can be of service. So please reach out with any questions, and we look forward to having conversations with you.
All right, and Jim, the result there was 65% with B, steadily increase.
Yeah, Amy, I accidentally closed it on my end. What were the answers for A and C?
13% for A and 23% for C.
Nice. So, you know, a fifth of y'all are true believers, close to a quarter. You know, I'm excited to see where it goes. They funded the program, right? Or they're throwing money at the program. So I hope, I don't know, I'm excited to see where it goes.